Good morning, everyone. Welcome and thank you for joining us. My name's Michelle Waitley and I'm the Specialised Business Bank Executive for Commercial Real Estate here at NAB. Before we begin today, I'd like to acknowledge the traditional owners of the lands on which we meet. I would like to acknowledge the Boonwurrung people of the Kulin Nation as the traditional custodians of the land on which I'm joining you from in Melbourne, and I'd like to pay my respects to all elders past, present and emerging. So welcome to our quarterly property market webinar series. One of the most common topics of discussion at the moment in property and in corporate markets is around the state of our office market, current and what does the future hold. Hybrid working and working from home and the impact on our CBDs, tenant demand, vacancies and incentives, sale activity and valuations, are they going down? And there's also a lot of interest in ESG and the carbon footprint of commercial offices. What's the impact of carbon on the office market and what will future requirements be? In today's webinar, we'll explore these issues. We'll share the latest insights and outlooks for the office market, including tenant flight to quality, new office supply and leasing activity. And we'll also provide insights on retrofitting to meet ESG and tenant expectations. Joining me from JLL are Paul Chapko and Piper Dedrick. Paul is a Director of Research at JLL based in Sydney. He specialises in office markets with a focus on providing JLL business and clients with all their research needs in this sector. Paul spent the last 8 years in the research space. Piper is an Associate Director of ESG at JLL based in Melbourne, and she provides information and support to clients on the opportunities and challenges of ESG as it relates to property. Having spent time in both Sweden and London and returning to Australia in 2021, Piper's well placed to bring global and local experience to her role. Welcome, Paul and Piper. So the property sector remains critically important to the Australian economy, and it has been a challenging time with the impact of interest rates affecting serviceability and movement in cap rates starting to affect property values. As Australia's largest business bank, I do want to assure you that we're open for business and we're here to support our customers to continue to grow and to work through any challenges that you may be facing. And we look forward to continuing to partner with you as your opportunities arise. We will have questions after the formal presentations. Please use the Q&A function at the bottom of your screen and we will get to as many as possible. And we're also recording the sessions, which we'll share with you afterwards. So on that note, I'm going to hand over to our first speaker, Paul. Thanks, Paul. Off you go.
Thanks, Michelle, for that warm welcome. I'm just going to quickly share my slides, so please bear with me. I think that Michelle hit the nail on the head that office seems to be a very hot point of discussion right now. We've probably all read in the press over the past few months around leasing demand, where valuations are heading to, and that impact that could play out over the next 6 to 12 months. Stepping back from that, on a more aggregated level, I feel like we've all heard the story around that flight to quality piece that Michelle touched on as well. And that is reflected in our aggregated office demand numbers. So net absorption for prime grade stock across Australia's CBD markets has been very solid over 2022 and in the first half of 2023. And that's been to the detriment of secondary grade office accommodation. So secondary net absorption has been very negative on an aggregated level over that period of time. When you look at metropolitan office markets or non-CBD office markets, that prime demand story has been also very positive. And you don't see a beige bar for secondary there as well, because secondary net absorption has been broadly flat on an aggregated level across Australia's Australia's metro markets. So just to give some context, we track 6 CBD markets across Australia and 13 metropolitan or non-CBD office markets. Our colleagues in the US have broken down demand in a different way, and this sort of inspired an analysis that we did for Australia as well, which I'll show on the following slide. So they essentially broke down net absorption by the age an office asset was built. So that chart on the right-hand side that you see there net absorption for US office stock built after 2015 has been very broadly positive, and net absorption for assets built in previous decades or in previous years has been overall negative. Now, we ran that same analysis for the Australian CBD office market for prime grade stock, and overwhelmingly, that thematic that we saw in the US analysis has played out in Australia as well. So assets built from 2010 to present have had the overwhelming amount of positive net absorption over the COVID period, so Q4 2019 to Q2 2023. And net absorption in prime assets built in previous decades has been negative. Now, my colleagues in the research team have pointed out some potential nuances to this analysis that I think has to be pointed out. So one of them is in the Sydney CBD, we had a lot of high quality premium grade office stock built in the 1990s. That stock was built on spec, and that coincided with a very big recession in the 1990s. So vacancy rates hit well over 20% in the Sydney CBD. But having said that, I feel like that 1990s bar doesn't paint the full story, because there was actually a lot of high quality stock built over that period of time. And that stock typically over the past 5, 10, 15 years has leased up quite well. So if you have a 2,000 square meter tenant leave an office building, and then that's backfilled by a 2,000 square meter tenant, the net absorption in that building is technically zero. So there is a lot of stock in that, particularly that 1990s period, that has maintained a high level of occupancy. So it really masks that negative demand result that we're seeing for 1990 stock. So the caveat to that is there was a lot of, I guess you could say, poorer quality or older style stock built. And over time, that stock was regraded and potentially gone from A grade to B grade, etc. And as a result, we've seen negative demand in that older stock as well. There is, perhaps unsurprisingly, mixed conditions across Australia's office markets. Starting on the positive side of the chart, or the left-hand side of the chart, the Brisbane and the Perth markets have really surprised on the upside. So the Brisbane CBD and the Brisbane Fringe have had very strong levels of demand over the 12 months leading to June 2023. That's been a small business story. So when I say small business, that's essentially sub 1,000 square meter tenants positively leasing or expanding into new office accommodation. And as a result, that's supported net absorption in these markets. We've also seen the emergence of the government sector, particularly the state government, in the Brisbane markets, which has positively supported demand levels over the past 6 months. And there is more activity by the state government to play out in the back half of 2023, which will further support positive demand levels and will likely help support vacancy rates trending down to about 10% in the Brisbane CBD, a number which we haven't seen over the past decade. So when the mining downturn happened in Brisbane, vacancy rates sort of hit the high teens, pushing towards 20%. Over that period of time, sort of from the mid-2010s, the vacancy rate has been trending down, but this government story that we're seeing play out is actually supporting demand levels, and we expect vacancy rates to trend lower. In the Perth markets, it's partly a professional services story, and it's partly a mining story as well. We are seeing those groups expand and positively lease space. In the Perth CBD, we're also seeing centralization activity, so tenants coming out of the suburbs into the CBD market, which is supporting positive demand levels. On the other side of the chart, there are markets that have had negative demand over the past 12 months. So with Parramatta, a lot of that negative demand has been concentrated in older style secondary grade office accommodation. We've seen a lot of government tenants vacate this space and move into government hubs in Parramatta Square, in Macquarie Park, and in the Sydney CBD. And that's been broadly to the detriment of particularly B and C grade stock. So when you look at vacancy rates in Parramatta, the overall vacancy rate of around 23% doesn't paint the full story of what's happening in that market. That market totals about 1 million square meters in size. about 350,000 square meters has been built over the past 5 years, so call it 1/3 of the market. When you look at the vacancy rate in that new stock that's less than 5 years old, the vacancy rate's about 8% versus the overall market of around 23%. So tenants gravitating towards new stock is a thematic, not only within the CBDs, but within the metro markets as well. The Sydney CBD, that's largely a larger corporate consolidation story. So the larger banks have downsized over this period of time. And we've seen the emergence of subleasing activity by larger tech groups as well, which have offered sublease space to the market, which has been detrimental to demand within the Sydney CBD. However, I know I'll sound like a broken record saying this, that small business story has been quite incredible and has actually supported demand levels over the past 2 years. That is hidden in the negative number that you see in the Sydney CBD, because the way I sort of frame this is, if you have 10 tenants, small tenants that expand by 500 square meters, that's positive 5,000 square meters of positive net absorption to the market. All it takes is one corporate to hand back 2 or 3 floors in the tenancy, and they might occupy space across 3 or 4 separate buildings. And if they hand back 5,000 square meters, which isn't a gigantic hit to their overall footprint, that negates that small tenant leasing story that we're seeing within the market. Return to office rates or work from home have been a global phenomenon. It's something that we at JOL are tracking quite closely globally. The data, unsurprisingly, varies from market to market in the sense of compiling data can be quite difficult in terms of trying to provide an aggregated number. So if you look at the Asia Pacific region, the return to office rates have been quite positive in terms of returning to pre-pandemic levels. When you look at some of those cities there, Shanghai, Beijing, Singapore, Hong Kong, and Tokyo, partly that's a government story in the sense of the government's encouraging workers to come back into the office, but it's also a household story in the sense of typically the size of the house or the apartment that people live in within these other Asian cities is quite small, and people actually want to be back in the office because they have a larger space to work in. That minus 30% figure that you see for Sydney, which is through a 30% when compared to pre-pandemic levels, I compiled that number, and that was basically based off tap-on and tap-offs of major train stations in the Sydney CBD, so Central, Town Hall, and Wynyard during peak hour times. And when you compare those tap-on and tap-offs, which is broadly white-collar workers going into office buildings, it's broadly around minus 30% when compared to pre-COVID numbers. So that's one metric that we gauge when trying to figure out what that return to office rate is within the Sydney market. When speaking with our leasing teams, unsurprisingly, the return to office rates vary from building to building. So there are certain office assets that may be premium or high quality A-grade stock that have a high concentration of private equity, investment banks, or financial institutions that have higher rates of occupancy than other precincts or assets where there's larger corporates, larger insurance groups, or larger banks where the return to office rates have been typically a bit lower. In the Americas, when you compare Asia Pacific to the Americas, the return to office rates have been a lot lower in the US. That's partly a safety story. So speaking to colleagues in the US, there's a perception of how safe you feel when leaving the office, particularly at nighttime, where crime rates are higher in some of these cities. And as a result, that has discouraged workers to come back into the office, particularly if they have to leave the office at night. And it's also a commuting story. So if you have a longer commute, you're typically more discouraged to come into the office because you have more time in your day to work or to deal with sort of life things like taking the kids to school or trying to do other things like that, etc. Subleasing is also another hot topic. When you break down sublease vacancy by the major CBD markets that we track, the overwhelming amount of sublease vacancy is within the largest CBDs of Sydney and Melbourne. when you break down that sublease vacancy, it's almost exclusively within premium or A-grade stock within these markets. And when you look at the type of sublease space that's been offered to market, it's largely by the larger corporates that have on the journey to figuring out what work from home means in terms of the office footprint and how much space they need to utilize. So we've seen a lot of larger financial institutions and utilities companies hand back space over the past 2 years to try and figure out how much space they actually need. And that is that work from home story playing out within the sublease numbers, in the sense that organizations realize that maybe 4 or 5 floors aren't being utilized within their office footprint, and as a result, they look to offer that sublease space to the market if it's not being utilized. As a result of that subleasing story and that consolidation piece over the past few years, particularly since the onset of COVID, we've seen vacancy rates rise to 20 or 30-year highs in some markets. But it is also a supply story. So over the past 2 years, we've seen a lot of supply hit the market, particularly in markets like Sydney and in Melbourne. And as a result of tenants pre-leasing that space and moving into that new office accommodation, that's left a lot of backfill vacancy available within the markets as well, particularly in Sydney and in Melbourne. And as a result of that, that's supported an uplift in vacancy rates as well. If you look at our outlook for vacancy rates over the medium term, the broad thematic is that we are forecasting vacancy rates to rise across half of the CBD market. So if you look at Sydney as an example, which is that darker blue line, we are forecasting a vacancy rate peak of close to 16% by 2024. Whilst there is a negative demand story that is playing out over the course of this year with the larger corporate consolidation and tech groups consolidating as well, we are seeing a big supply wave that will hit the market next year. However, if you look at that chart on the right-hand side, the blue bar, which is the Sydney CBD market, whilst there's a spike in development activity next year, there's no completions that we're forecasting over 25 and 26 before another potential spike in 2027. So the supply pipeline is very clumpy in a market like Sydney, whereas if you look at Melbourne, the supply pipeline is quite sustained of around 100,000 square meters of completions per annum over the next 4 years. That supply story is quite substantial across all the CBDs, like in Melbourne, in Adelaide, and in Perth. We are seeing positive leasing activity within all that new space. It's more a story around how the backfill vacancy gets leased up. We are already seeing some signs of that backfill vacancy be leased up in markets like Sydney. But despite that, we still expect vacancy rates to rise as a result of that supply story. Transaction volumes are also an interesting point to touch on. We were actually discussing this prior to the call around what transactions are happening and what that means for valuations going forward. Overall, when you look at the office, the retail, and the industrial and logistics investment volumes for the first half of 2023, they have been very low. When you compare it to the first half of transaction volumes when compared to previous years, we're at the lowest levels over the past decade. We are still in a period where groups, buyers and vendors are going through a period of price discovery. We have seen a number of key transactions go through, particularly in the Sydney CBD over the past 3 months. So 44 Market Street and 1 Margaret Street, which actually transacted or exchanged over the weekend. Those transactions roughly reflected a 15 to 20% discount to book values, which everyone has been talking about over the past few years in terms of where we're going to get to in terms of a price correction. We are getting some deal evidence flow through into the market now. I feel like we need another 1 or 2 transactions within the market to help establish a benchmark of where transactions are heading to. But it's good to see that we are seeing some liquidity play out within the market. But broadly speaking, it is quite weak for the time being, as buyers and vendors try to go through that period of price discovery. No one's being forced to sell. There aren't fire sales happening across any of the sectors, that being office, retail, or industrial and logistics. I think it just takes time for vendors to get used to where the elevated cost of debt is, where interest rates are at, and buyers becoming more comfortable with where pricing is in terms of where that cost of debt is sitting at in the context of the broader market. On that chart on the right-hand side is just a reflection of how global transaction volumes and the share of investment has shifted over the past decade. So back in 2010, office was viewed very favorably, and a lot of global asset managers were looking to expand their portfolio to have a large proportion of office within it. As the decade rolled on and where we are now, in 2022 and heading into 2023, office is viewed less favorably, and living in multi-family or BTR or multi-housing is viewed in a more positive light. And over that period of time, industrial logistics has also grown in favor from 10% of overall transaction volumes in 2010 to about 90% in 2022. I'll now throw it over to my colleague Piper, who will talk about ESG.
Thanks, and if I could just get my video turned on. Just waiting for my video to turn on, and then we can get started. Thank you. So sustainability momentum, it is now well and truly here. For a long time it's been building, but there is more and more evidence today to say that ESG and sustainability is here to stay and has significant impact on real estate values. A recent survey by JLL, we were able to see that 72% of investors saw real value in that green certification. So that is a NAB's rating or a Green Star rating, as well as employees really starting to choose places that demonstrate sustainability-driven initiatives in their business. This is definitely being underpinned by the Gen Z generation coming up through the workforce. What was the most interesting part out of this survey, though, was the occupier piece. We were able to deduce that 40% of the occupiers surveyed in this had a net zero carbon goal, with 80% expecting to have one by 2025. So what this means for yourself as a real estate landlord or working in the real estate industry is that we are going to see these occupiers really be the driving force of transitioning real estate to more sustainable premises as they require to meet those sustainability outcomes that they've set. Thanks, Paul. So why should we care? Well, real estate makes up a big part of the world's global emissions, 39% actually. So we should place a big emphasis on the buildings that we live in and how we use them, as they are contributing to global warming quite significantly. Embodied carbon. So embodied carbon is the emissions that go into creating a building. So building new buildings require trucks, require steel, require concrete. All those emissions is what we call embodied carbon, and they make up 11% of our global emissions. The other major piece is the operational carbon, which makes up 28% of global emissions. Now, operational carbon is when we turn on our lights, when we run our hot water, and it's using gas. So if you've got an existing building, the embodied carbon piece potentially doesn't relate to you as much, but that operational carbon piece is where you can really make that big impact and reduce that 28% as down as much as you can. Whereas if you're a developer of real estate, that embodied carbon piece is really where most of your emissions will be coming from and where you contribute most to the global CO2 emissions. Thanks, Paul. So are investors prioritizing due diligence, the ESG in their due diligence? So a part of my role is making sure that we address ESG upfront during our transaction campaigns, because we are seeing investors prioritize ESG higher and higher on their due diligence list. we've seen that 2/3 of investors would potentially turn down an opportunity based on ESG standards. In Europe, for example, I'm aware of deals falling apart because of, say, the ability to transition and remove gas out of a building, out of a building being too costly, versus I'm going to show a couple of case studies in a minute about Australia. So driving this is really, again, that increased regulation and incentives around delivering sustainable building, the financial impact of potentially from insurance premiums being too high to also having longer vacancy periods because you're not able to attract sustainability driven tenants, and as well as that overall stakeholder pressure that's coming from everywhere. It's coming from occupiers, their employees, everyone in the market, finances such as NAB, really driving that change. So investors are really prioritizing ESG at the very top of their list. Thanks, Paul. So there have been 2 case studies in Australia so far where we've seen ESG, particularly around that environment piece, be the detriment to a potential campaign or resulting in a price shift. Now, both of these were before the interest rate rise. The first one was an office in Sydney. So it's an office in the CBD. It was going to an institutional capital. They were the preferred bidder. And during the DD process, which as we know at this point of time is that can be very costly and fragile in making sure the deal gets done, they were taken through the entire process until they decided to get a climate risk assessment done on the building. So they used their own external providers and deemed that the property was at too high a risk of flooding to go from sea level rising to go through with the deal. They wanted to hold this building in their portfolio for a long term. So understanding the long-term implications of the potential physical climate risk, they deemed that too high. So they actually pulled the deal. So obviously this cost everyone a lot of money and a lot of time, but it also then undermines the ability to go out and resell that property, because as you all know, the real estate industry is quite small. So these type of things can get out into the market quite fast and then create this negative energy around potentially why someone wouldn't want to buy that property when they were so far in the due diligence phase. The second case study is a shopping centre in Queensland. So this property flooded 10, 15 years ago, and there was no change to insurance at that time or the cost of insurance. However, when the institutional owner decided they wanted to divest from the property, they were faced with the problem of not being able to renew their insurance at the same cost. The insurance company said to them, we expect the premiums to be 300 to 400% higher. However, we will not provide a cost on that insurance until you get a bid. So I'm sure, as you all know, and very aware, during that transaction process, being able to place a bid on a property without understanding your operating expenses is quite unique and not something that comes across very often. So that created a bit of friction, and it resulted in the institutional target buyers that JLL was looking for. They revoked their interest in the property, and it was only left to a smaller, more private group of capital. This resulted in about a 10 to 15% price chip. They were able to get someone to buy it and go through with the deal. However, that ultimately brings down the value of their property and the long-term vision of that. It's worth noting this happened before the interest rates rise. So it could be speculating that potentially that 10 to 15% price chip could have been much more had that been trying to be sold today. Thanks, Paul. So where is this policy and drive coming from in terms of regulation? Well, I'm assuming that we've all heard that the government has committed to net zero by 2050, with a 43% reduction by 2030. Now, initially the federal government is focusing on those massive big ticket items, and in Australia that is actually our energy grid. So we're not seeing so much policy yet come out of the government directly impacting commercial real estate. It is a similar story with the states. They have set their own interim, more ambitious targets, some of them. However, it is the local councils that are going to be really driving that transition to a more sustainable product through policy in the cities. So we have the City of Melbourne. Their policy is in progress, and they have set a net zero target by 2040. In the recent JLL research paper came out and was able to sort of prove that in the city, buildings make up emissions 66% of total emissions in the CBD. So I think before I talked about that 39%, that can differ depending on where the density of buildings are. And within Melbourne CBD, it's 66% of the total city's emissions. So what that means is that the City of Melbourne has a real drive to want to try and bring down emissions in buildings. And I think they have a target of retrofitting 70 buildings a year to be able to get to this target. And they're really going to come out with policy, most likely the end of this year, early next year, where they will say you must build your buildings to a new higher standard, so a minimum NABERS rating. And if you're retrofitting a building and you're impacting a certain percentage of that building, you would trigger the clause to have to bring up the whole building to a higher energy efficiency standard. So that is a NABERS rating. A similar story in Sydney. They have a 2035 net zero target, which is very ambitious. It's only just around the corner. And the emissions from buildings in their city come to 55%. So they also have a very strong ambition to bring down the emissions of buildings in the city. So their policy has been recently confirmed, and that really is focusing around on the fact that you need to build very energy efficiency buildings today, as well as if you're impacting a certain amount of your building, again, bringing up that energy efficiency standard to a higher level and triggering the clause for the whole building. So it's really tough policy coming out of our local councils, but it would really shift the needle in terms of getting actual change happening in our cities and across our buildings. Thanks, Paul. A global reporting standard is also coming our way. I'm sure you've all heard of the IFRS, which is the International Financial Reporting Standards, and they're essentially the accounting experts of the world that set the framework on how accounting principles should be followed. They've come out and set up the International Sustainability Standards Board, it's a bit of a mouthful, and they're essentially doing the same thing, setting up a framework to calculate emissions and encourage businesses on how to report on them. It's expected that Australia will take this on as mandatory as of next year. However, the turnover and threshold for businesses to report is 100 million. So it is for those larger businesses who contribute the most. However, what's really important to understand is that they're discussing now whether or not they should be including their Scope 3 emissions, which is essentially looking at their supply chain. So if you have any relations with a large institutional or corporate provider, you may be required to report your emissions up to them. So it's just something to consider and think about and understand how changes like this will be impacting your business. Thanks, Paul. And again, one more change is NABERS is changing. So if you are not already aware of this, it is vital that we understand it, given how much the commercial market relies on NABERS rating as a signal to occupiers about the energy efficiency of the building. So from 2025 and 2030, NABERS will be changing their emission factor. So that is the amount that they put dependency on the fossil fuels in the building. So for example, if you have a building that is maybe highly energy efficient, say you're achieving 5-star NABERS, but 30% or 40% of your energy use comes from gas, you potentially will see a decrease in your NABERS rating based purely on that gas use. Whereas in reverse, if you've got a building that's say 4.5 stars, but you're already all electric, maybe your building's based in Brisbane, there's a lot of all electric buildings based in Brisbane, that will in turn lift your NABERS rating. So 2025 will be the first change for that, and then again in 2030. So really making it a bit hard, making it harder to achieve certain NABERS ratings. The second change to NABERS is that as of June this year, there is no more green power certification, additional half-a-star green power certification on your NABERS energy rating. They've scrapped this and they've said we're going to come out with a renewable energy indicator. So that is detailing the percentage of energy use that comes from renewable energy in your building. So it will be a pie chart on your NABERS certificate, breaking down your energy use. So you'll be really able to see exactly where your energy use is coming from in your building. This will again just provide further transparency to the market in terms of how efficient our buildings are, but then also what energy source we are using. Thanks, Paul. So do tenants care? Well, the answer is yes. And as we saw before, we saw that 40% of our corporate occupiers have net zero targets. They are already well ahead, and we're looking at sort of 80% by 2050. However, it's the small to medium-sized businesses that are also now really driving the change. As Paul said earlier, we've seen a real shift in that sublease market of those small tenants moving, and they're coming to the table now to our tenant rep team, asking for premises of, say, they're only looking for 500 square meters, but essentially they're asking for a minimum 5 to 5.5 star NABERS. The reason this is that they understand, and as the market understands what a NABERS energy relates to your operating expenses, they see that as a risk to be moving into a building that has a low NABERS rating versus one that has a high, because they don't want to see their energy costs fluctuate. For small businesses, energy cost fluctuating obviously impacts their bottom line much more dramatically than it does, say, for a corporate occupier. So it is coming from all directions, and it is from even those small tenants. They might not necessarily have that strong net zero target or any sort of formal policy around reducing their emissions, but they understand that if they're in a highly energy efficient building, they will hopefully have a more stabilized energy cost and usage. So have we seen that occupier demand that I was talking about really hit the market and really move the needle? Well, the answer is yes. JLL has been involved in a recent leasing deal where the occupier was in a building. The building had a lot of gas. The occupier had a net zero target by 2040 with interim targets to decrease their emissions, say, by 60% by 2030. So they understood that the building that they occupy contributed a lot to their emissions, and they necessarily didn't want to leave, but they knew if they stayed in the building, they wouldn't be able to meet those targets. So working with our tenant rep team and our sustainability consultants, a solution was brought to the table whereby in the lease agreement, the occupier was able to demand that the owner electrify their assets by 2030. Otherwise, they can completely have a break right against that clause. Now, we haven't seen anything else like this in the market yet, but we expect that this is where occupiers who have strong sustainability commitments will keep pushing landlords to come to the market and say, we're going to upgrade those buildings. Now, they don't expect them to do it today. As you can see, this occupier pushed the landlord to do it by 2030. However, for thinking about your own business, it's more understanding that this might come to you and how well are you prepared? Have you been able to look at your business cases and your business plans and understand which items in there are coming up for CapEx replacement, and can you pick an option that decreases your emissions further than, say, what you had originally planned? This will put you in a really good position. So when those occupiers say, hey, I want to be in an all-electric asset, you'll be like, we've got that factored into our business plan in the next few years, and it doesn't come necessarily as a surprise to yourself. Thank you, Paul. And lastly, are we seeing the reward, basically. Obviously, a lot of this needs to be financially smart. It needs to make financial sense. It can't always just come from the landlord's pocket. There needs to be a reward for making those decisions. So our Q1 data for Melbourne CBD, we were able to show that sort of since the COVID pandemic, the bifurcation between less than 3.5 stars to 5.5 stars has increased. Buildings on average with 3.5 star neighbours had a vacancy of 23% versus those with 5.5 at 15.7. And I understand that 15.7 still isn't super favourable, but in a very tough market that the office and the commercial space is facing right now, it really does make a big difference to your bottom line if you're able to bring down your vacancy and get income into your building. There's obviously also a significant rental premium which has grown. So in Q1 2020, that rental difference was 109 and now it's 152. So we're seeing again that bifurcation between vacancy and the average net face rents growing. And that's all from me. I'll hand it back over to Michelle and we can see if there's any questions out there.
Thanks, Piper. It's a really fascinating topic, and thank you, Paul, for your presentation as well. Just a reminder, there's a Q&A button at the bottom of your screen, so if you do have any questions, please put them in. We'll have about 10 to 15 minutes of questions. So the first one is for you, Paul. So where does JLL forecast cap rates to go in FY24 in CBDs and fringe CBDs?
It's a good question. It's $1 million question. We are still anticipating some further cap rate softening in the back half of this year. I'll be the first to put my hand up. We've been a bit in the dark in terms of where cap rates could end up at, just because of how illiquid the markets have been over the past year. We definitely know, not to state the obvious, that cap rates have softened. We're of the view that that cap rate softening cycle will end at the end of this year, potentially into the first quarter of next year. If you're looking for a number, we've sort of softened on average for CBD prime office markets aggregated by about 95 basis points over the past year. And we are forecasting about another 25 basis points further softening in the back half of this year.
Okay, and while you've got the mic, Paul, where are you seeing rental growth across the various office markets?
It's interesting because I think Piper touched on it as well, where the vacancy rates don't look particularly fantastic in any of the markets, but we are still seeing face rental growth. So in markets like the Sydney CBD, we've seen a big gravitation of tenants towards what we call the core precinct. So around Circular Quay, got beautiful harbour views, you've got high quality office product that's there, and the occupancy rates or leasing activity within those towers is quite positive and tenants are pushing towards it. And as a result of that, we've seen quite strong rental growth in that part of town. Having said that, incentives do remain elevated, and this is a story across all the CBD markets across Australia and the metropolitan markets as well. So if you go to a market like, say, Parramatta, rental growth has been broadly flat in terms of face rents, but what we call effective rent, which takes into account the incentives, it has been quite negative because vacancy rates have trended up quite strongly. Unfortunately, you have to touch on every single individual market to sort of talk about the rental growth story, because there are nuances across all the markets. But broadly speaking, if you want to sort of take a key takeout, face rents have either remained stable or have increased across the CBDs and the metro markets, but incentives at the same time have been trending upwards as well. And as a result of that, we've seen negative effective rental growth virtually across all the markets that we track in our database.
Great, thank you. Piper, one for you. What's the current regulatory process of establishing NAB's rating levels for a building to be constructed?
In terms of, I guess they're looking at in terms of getting a NAB's rating pre-committed or a target NAB's rating. So that is through the NAB's process. So it would be working with the consultants to estimate what your neighbour's target would be based on your building materials and how you plan on constructing. For that person who asked it, I think it would be very much worthwhile them looking at into getting in touch with a consultant who can help them understand how to get that best neighbours rating at the very initial stages of their planning process and construction. Because if you're doing it sort of midway through construction, there may be some fundamental things that needed to be changed that you can no longer do based on attempting to get that higher neighbours rating. So it's definitely one of those, again, having ESG at the top of mind and sustainability at the top of mind during your decision-making process, and addressing it early on will have dramatic impacts on what you can deliver.
Okay, thanks, Piper. And we've always heard a lot about offsets. Can you talk about the offsets in real estate? Is that a viable option for a sustainable strategy?
Well, we've definitely seen the shift away from promoting maybe the use of offsets. Whilst there are some very good offsets out there, it is a market that's not maybe delivering on its intended purpose. And a lot of the time you can think of offsets as, say, a band-aid when it maybe needed a cast, and looking at how you can actually structurally change your building rather than spend money and decrease your net operating expenses through paying for offsets, looking at how you can improve the energy efficiency through CapEx and then ultimately improve your building's performance and reduce your operating expenses is a much more considered approach on how to treat offsets. So JLL's position is very much action first, offset last, as the way to decarbonize your portfolio.
Thanks, Piper. I've got a question here which is specific about Newcastle Heritage Office, but it might be worth just broadening the conversation around heritage buildings, which are often C-grade buildings. Are they more driven by future development potential?
I can't really talk to Newcastle, so apologies on that. That's not my area of expertise. In all fairness, because there's so many planning restrictions around heritage, you can't really do anything all that extensive to them. Not to throw Piper under the bus, but like,
no,
is
it
there
is.
sort
It
of
is
like a view on ESG on heritage, Piper? Like I've never really heard of examples of. Maybe there are examples of high quality, higher rated ESG assets that are heritage.
When we've worked with our sustainability consultants, it's about finding the place where they can put this plant equipment to improve their energy efficiency. It is a case by case basis, so I'm sorry I'm not able to sort of give a one size fits all given the complexities around heritage. But I know our sustainability consultants have come up with solutions where they've said, okay, let's shift the heat pumps to the roof. However, we can't have them too close to the street frontage. We need to have them further back, and working through that with local council to make sure that they're adhering to the heritage rules, but also able to deliver. And local councils, they want these buildings to be upgraded. So they are going to also have to come to the table and be more flexible with the use of heritage buildings and how we transition them to sustainable assets.
And just going on that in terms of redevelopment potential, we've seen some amazing examples in Sydney and in Melbourne over the years around maintaining the heritage aspect of the site and then building essentially a tower on top, or completely refurbishing a heritage asset. In the case of Sydney, beautiful sandstone buildings that were utilized by the state government that was vacated, and a hotel developer came in and basically redid the interior into this amazing luxury hotel. So the capabilities there, and it is possible. The problem comes down to cost. Construction costs have skyrocketed, as we all know, over the past couple of years. And we've seen in our development pipeline for existing office stock that is not necessarily linked to heritage, but just overall new construction going forward. We've seen those supply pipelines for office drift out into later years or just be mothballed just because it's too expensive now. And to get to the economic rent for some of these developments, it's just not feasible. So it also ultimately boils down to a cost issue as well. And I think a lot of developers are on the sidelines now, just waiting for costs to normalize because they've gotten a bit out of control over the past few years.
Thanks, Paul. Question here just about office in regional locations, and do those trends follow the same as, metropolitan non-CBD markets?
The one, and it's only one, mind you, example that I can sort of speak to is Wollongong. And on the flip side, there's the Gold Coast as well, which I know may not necessarily, I don't want to offend anyone. I hope I haven't, that's a regional location, but starting with the Gold Coast, that demand story for office space in the Gold Coast has been quite incredible from what I've heard. I haven't dealt with that market all that much, but sort of the investors that I've spoken with and leasing agents there have said that that market's performing very well. It's a small business growth story there as well, which has supported, mind you, the limited amount of office stock that is there, which is about 100 to 200,000 square meters of office space versus, say, a Melbourne CBD that's about 2.5 million square meters in size. So there is a positive demand story there. In Wollongong as well, whilst the composition of tenants there is mainly skewed towards the government or sort of professional services organizations, that demand story is quite patchy in the sense of you have periods of over 6 months where you get some positive leasing activity. Then for the next 6 months, nothing may happen. And then it's sort of, you might get some activity down the track. So unfortunately, painting a broad brush stroke between the regional areas and the metro markets and the CBDs isn't that clear cut because the markets are a lot smaller there. And that demand story is quite patchy in terms of tenant demand.
Yeah, and definitely too from an ESG perspective, it may not be as direct and in your face in these regional markets, but again, everyone is understanding the impacts of burning fossil fuels. So we're starting to see just general attitudes towards buildings that change and how we live and work in them. So whilst it may not be as direct, there's definitely trends coming through conversations between our tenant reps and landlords about even those areas, sort of saying, oh, I'm surprised that they asked about how energy efficient the building is. And just those questions are now starting to come through. So whilst we expect the trends, particularly also from what Paul's talking about, they will filter through as they do from Europe filtering through to Australia and then from the major cities filtering out to the regional cities.
Great, thanks, Piper. And just one more question for you, Paul. So you did mention a couple of transactions that we've seen in the last couple of months and the one over the weekend in Market Street. Are there any assets that are for sale at the moment that we should keep an eye on, just in terms of, impact to valuations?
So 60 Margaret Street has been in the news for the past few months as well. So that's one to look for in the Sydney CBD. There are other markets that I need to be careful about which ones I say so I don't get in trouble. There's one that's been reported in the press. Charter Hall was selling 333 George Street, which is a high quality A-grade office tower, boutique in size in terms of how big it is. So the expectation is that could do quite well. There are a number of assets over the year, and I won't name drop because I don't want to sort of go down that rabbit hole, that have come to market and that consequently haven't sold. They've been in the news. Pricing just didn't get to where that vendor wanted to, and it sort of goes back to my previous point that there's no forced selling happening. Yes, there are sort of redemptions in terms of funds, and those REITs will have to pay out those investors that want to cash out. But broadly speaking, those investors will get paid out. It's just a matter of when, and there isn't any forced selling happening for the time being. So I think 60 Margaret and 333 George Street are ones to look out for if you're sort of trying to track some transactions.
Great, thanks, Paul. So we're going to wrap it up there, everyone. So hopefully you've found today's webinar really informative. Thank you so much for dialing in, and thank you so much to Piper and Paul for your fantastic presentations. For our customers on the call, I would like to take the opportunity to thank you for your custom. We do value your business, and we look forward to continuing to partner with you with your ongoing opportunities. And if you've got any questions or concerns, please contact your banker. And if you'd like to explore any interest rate strategies, we can put you in touch with our market specialists. So please stay in touch. As we close, you'll receive a survey. We'd really appreciate it if you'd take the time to provide us with some feedback, and particularly provide us with any topics for future webinars, because we want to make sure that we make them as relevant as possible for you. So thank you very much. Goodbye and enjoy your day.